All right, hey, it's Gerardo again here. Another episode of Beyond 9 to 5 Real Estate Podcast. Here with my co-host Lorenzo. How you doing, Lorenzo? How's your week?
I'm doing good, brother. It's just a crazy market, man. It's thankfully I'll be closing something this week. So
Awesome. Congrats. Congrats to you and your clients.
yeah,
It's not
man.
easy.
That old adage of cash is king didn't always pan out in this market, man. But at the end of the day, man, they stuck through it and they were able to find, I think, the best house for them. Legit.
Awesome. Good for them, man. So we got a few things today on the agenda to cover. Conventional versus FHA loans, just to kind of give a little more insight on what the differences are with each route, depending on who you are as a buyer. We're also going to touch base a little bit on non-QM loans, non-qualified mortgage loans, and also Prop 19, which is one of the components of Prop 19 is the transfer of property tax base. So for people that are older, they can take that with them. They could take that old property tax rate with them. So we'll discuss those briefly. In general, have you had much experience with non-QM loans, Lorenzo? Or
You know what? I haven't had a client go that route 100%, but I have a couple of investor clients who, have considered that route just because, it's an option that they could qualify for one of those non-QM loans rather than going that traditional route.
yeah, and just to kind of touch base a little bit more on what non-QM mortgage stands for. It's a non-qualified mortgage. So most agency products, which would be conventional or government loans like FHA or VA, those are like the most traditional mortgage types that people use.
Yeah.
Right? And a non-qualified mortgage is a loan that it's not required to meet the agency standard for as far as documentation requirements. So a lot of the lenders, they'll do mortgage loans, let's just say under the conventional product. Then they'll sell those loans off to an investor, Fannie Mae, Freddie Mac, a lot of different investors, but those are the two biggest main ones, mainly being Fannie Mae and Freddie Mac. For the non-QM loans, the client doesn't have to abide by these certain agency standards of documentations, right? If it's a Fannie Mae product, they're going to look at your income a certain way. If you're self-employed, they're going to take an average of the 2-year net income of your business most of the time. There's some stuff that they can add back, like depreciation and things like that. But typically, self-employed, they're going to look at that 2-year. With the non-QM loan programs, it's a little bit more lenient when it comes to the income, or there's just different ways that they can analyze it. A clear example would be like a business bank statement program. If you have a business that makes, I don't know, let's just put a round number on it. It makes $250,000 gross a year, right? By the time that they deduct their expenses and rent and a lot, different expenses to minimize their tax burden at the end of the year, that income is going to look like a lot less. So for these business bank statement programs, they'll analyze your income a little bit different, where they'll take an average of your deposits. Let's just call it, one program is for 12 months, right? So you own a business, you deposit your income into this business bank account. Let's just say you own a gym and all your members' fees get deposited into this account. The bank will use an average of the deposits for 12 months and use either 50% or up to 80% of the income to qualify you. So 80% if you're a sole owner, one person type of business. 50% if it's a bigger business with multiple employees and independent contractors and that kind of stuff. But for someone that has a business where they're looking to minimize their tax burden, but the business has good cash flow, good revenue, they can use a little more of that income to qualify for a property under this program, under a non-QM type program.
Now, I'm curious, man, you being on the lending side, right, is a little different because as a realtor, my thing is I need to provide solutions to my clients, right? So if it's not the FHA route, if it's not the conventional route, well then it's, hey, well I have this lender who has these programs that are available to you. Let me send them that way. How a percentage, what percentage of like applications do you get for these non-QM loans?
Uh, a fair amount, to be honest with
Really?
you. Right now, I would say, I don't know, 40%. Forty
Wow.
percent of my applications are non-QM mortgage programs. Now I'm a mortgage broker, so I have access to banks that offer these programs.
Yeah.
If you go to like a major bank or something or some kind of direct lender like that, most won't offer it. There's some direct lenders that do, but most like big banks, credit unions, that kind of stuff, they're not really doing the non-QM mortgage programs. They're doing more of the agency products.
Yeah.
But because I'm on the mortgage broker side, I do get a lot of these. I also work with some investors that use these products as well. So like, if you're looking to buy multiple properties, investment properties, but like here's an example. Okay, if I bought two properties last year, but they're being remodeled, there's no income coming in yet, but I have the down payment to purchase a third, and I have the opportunity to buy it. Without the income on these other ones, it's going to be hard to qualify the traditional route.
100%.
But if we're using a non-QM program like the DSCR program as an example, where they use the expected rental income from the property to qualify for the mortgage.
And how far out into the future does it look?
Well, they just look at what the monthly rental income on that property will be,
Would be okay.
as opposed to what the mortgage payment is going to be. So if it makes sense, they'll when they do the appraisal, they'll do an average. They'll get an average rental income for that property through the appraisal and get a good idea of what the rental income could be. Now, in some markets, the rental income could be higher for short-term rental. So, like I have a few clients where they're purchasing property specifically for short-term rental, right? So that for the non-QM loan programs, their interest rate is typically higher, but for them it's worth it because they're still cash flowing for the use they're looking to have. Like I have one client where he buys property specifically in Indio, close to Palm Springs, close to Coachella concert grounds, right? And his places are always booked. So if he can get the property, he's okay with paying a higher interest because it's worth it to him. He's still making profit on the rental income.
Yeah, I mean the name of the game is building the wealth.
Exactly. He's looking specifically for short-term rental income, and he's looking to build equity and build wealth long-term by holding the real estate. And that's a great strategy. I've used these programs myself. I invest in the Joshua Tree area. I have one Airbnb up and running and two that I purchased recently that are being remodeled and fixed up at the moment. But I use these products as well to purchase those properties. So it makes it easier to get in. Later on, you can always refinance it. Like a lot of people right now are scared. Rates are going up in general, right? We were looking at a conventional, on average, 3% a year ago. Now it's closer to 5%. So the sticker price, if you were looking for a property within the last year, you're looking at the same price, but the mortgage payment's going to be a lot higher right now. But the rates could come down in the future at some point. Obviously, depending on where the markets are, the rates are shifting. Because of COVID, they were down for a while, and now they're going back up, but that's going to come in waves. So if you hold a property now, especially as an investment, if it still makes sense cash flow wise, you can look at refinancing that in the future. A lot of people end up refinancing anyways, whether it's to take money out, remove mortgage insurance, or lower the payment, or whatever the case might be. So take a look at the whole picture. If it makes sense, you could always refinance in the future, even if it takes a little bit of a higher rate to get into that property at the beginning. If it cash flows, it makes sense.
Yeah, I mean, I agree 100%. At some point, that opportunity will be there to refi, and I that's what I have to kind of convey to some of my clients is like, hey, if they're going one of these routes, there is opportunity to lessen those payments monthly.
Yeah. And apart from that, obviously we can look at the conventional versus FHA loans, which the majority of people use. Both great products. The non-QM is just kind of like a different option for people that have tricky income to analyze.
Yeah.
But let's go over in general conventional versus FHA loan, right? So FHA loan, Lorenzo, I'm sure you're familiar with.
100%. I mean, government backed. I'm going to say the clients that I work right now are about 50-50. It's going to be primarily FHA and conventional. And it's going to have its benefits 100%. The requirements are a little more flexible for you to get a mortgage. And especially if you are a first time home buyer, or you're trying to maneuver another route to maybe get another investment property, this FHA route is amazing, albeit in a seller's market. Like we've been dealing with now, those to close on a property with the FHA loan has been a little bit tricky.
Yeah, you got to come in with a strong offer
Yeah.
for them, because it could be looked at as being a harder loan to get approved.
Yes.
But if you prepare correctly up front, it can be done right and you can close it fast. So, the benefits of FHA loans: takes a lower credit score to qualify, right? Some lenders can go as low as 580. I've even heard as low as 500. But if your credit score is that low, most of the time, the reason for it being that low might deter you from being able to get approved for the loan, because it's not just about the credit score, but also what's holding the credit score at a low amount. But in general, you can qualify with the lower credit score without your rate skyrocketing, as opposed to with conventional. The rate's going to go up a lot more if your credit score is lower. Also, your mortgage insurance is going to be the lower your credit score, the more expensive the insurance under conventional, as opposed to the FHA loan is just a standard mortgage insurance premium rate. So if your credit score is going to be a little bit lower, it won't affect your mortgage insurance monthly per se the way that it would under a conventional loan. But both products offer low down payments. Conventional as low as 3%, FHA as low as 3.5%. Conventional, depending on the loan amount, it could be 3 or 5%, right? With FHA, the lowest is always 3.5%. So I actually use my primary residence, a duplex that I bought. I used FHA to buy the property. Our mortgage insurance was pretty high, but we were able to get into the property, fix the property up a little bit during the first year that we owned it, as well as values increasing in our neighborhood. And a year later, actually maybe like 8 months after purchasing it, we were able to refinance and remove the FHA mortgage insurance and replace it with a conventional mortgage insurance, which the difference for our particular property went from $800 to like $90 for the mortgage insurance. So the payment went down significantly because of that, but we were able to use FHA to purchase a property at a low down payment.
Okay. Yeah, that's one of the big things. I mean, especially when you are working with first time home buyers, the question that I get asked is, what am I going to qualify? How much do I need? And that's why if somebody is 6 months plus removed from actually going out there into the market and buying a home, my first thing is, right now you need to go and speak to a lender, because they're going to be able to guide you and put you more or less at ease as to what route, conventional, FHA, to go, and what you need to have prepped to have the best chance to land a home. I mean, that's what I have to do 60% of the time.
Yeah. And for those lenders that have a complex file, Sometimes you go for those clients. I mean, they have a complex file. Sometimes you go speak to a lender, and they see it as being a little complex, and it might not be willing to put forth the effort that you need, right?
Yep.
So I would, if I'm a buyer, or what I would recommend to buyers is, speak to that lender that's going to commit to putting forth the effort to helping you get the property that you want, to helping you get approved. It's not necessarily going to be easy. Sometimes you might have to speak to a couple different lenders and just compare opinions and strategies and things like that. But ultimately, doing the work up front as a buyer and interviewing a couple different lenders if you're not satisfied with the initial conversation is a good thing to just compare and be able to formulate a good strategy to come in with a strong offer to get your property accepted.
Yeah, there is a solution out there, 100%.
Especially once you get into the thick of escrow, as you know, it's important. The communication's important. Hey, where are we at with the loan? What do we need to get it closed? Mr. Lender's not calling me back. Like, all those things are super important when we're in escrow now. We're on a time budget, right? Where we have to.
I mean, going from 2018, 2019, I think I was closing on average 30 to 35 days for escrow. And in 6 months, we're at 18 to 21 days. And if you don't have, all your ducks in a row and everybody is in constant communication, it gets nerve wracking on the agent side, and I'm for sure on the client side.
Yeah, which actually brings us to another thing that I always advise clients is get pre-approved before you start looking at properties, because it's so competitive. By the time you find a property that you want to place an offer on, you need to be ready to go, because if you're gonna look at a property over the weekend, Saturday and Sunday, and now you need to be pre-approved to submit your offer by Monday, it's going to be a lot more difficult to have someone work on the whole file, especially if your file's complex or if unexpected issues arise. You want to have time. You want to have that sorted out. So when you do find that property you like, you're able to act on it, and you're able to submit an offer in a timely manner to help you get your offer accepted.
Yeah, and I mean, every market is going to be a little bit different, but I know in this one, when I do come across somebody who wants to view properties and they are not pre-approved, the conversation becomes, well, we went from 12 days on the market to about 7 days on the market, which means if you see a home that you like, most likely it was that weekend that it was snatched up. And not only that, but the strategy going in to putting an offer on the home that's going to win the bid is different. If you're, if you think you're going to be pre-approved for 800,000, and let's say you take a good guess and that's where you want to start looking, well, truth be told, in this market, it's probably start looking at the 740,000, so you have that room to move that bid up to give yourself that best opportunity to win. And that only comes from being pre-approved and speaking with a lender before you go out there.
Yeah, being ready to go.
Yeah.
That's an important part. Absolutely. And I think it's, if you're not in the market yet and you haven't been looking and you're going to start looking, a lot of times it's like, well, let me find something first and then I'll go through the whole pre-approval. But in reality, it should be the other way around. It's like, let's get pre-approved. At least you know where you stand. If you find a property for $600,000, you know what $600,000 means monthly payment wise because you spoke to a lender. And you avoid the whole, okay, let's place an offer on this house at $650, and then realizing the payment's a lot higher than you thought it was going to be, and kind of being shocked at that as you're in the middle of placing an offer and deciding if that's the property that you want. There's a lot of emotion and back and forth decision making going on at that moment in time. The last thing you want to do is add that extra layer of surprise with the loan. You want to kind of know already what you're getting into.
Oh yeah, and I mean, I'm sure you've seen it when I'm on the MLS looking for properties for clients. I mean, the amount of back on the market that is, attached to some homes, it probably does speak to not having your ducks in a row, getting into escrow and then not being able to perform. and that really comes from having, someone good, a good team behind you to tell you, hey, maybe that's not the best route to go through if we're trying to win this bid.
Yeah, yeah, exactly. Yeah, because the last thing you want to do is get into escrow, deposit your earnest money, and to realize due to the financing, it's not the route you want to take, or now you got to make a change halfway through escrow, but you still might want the property. You will kind of want to have that figured out prior to. So, yeah, it's a good strategy. Conventional versus FHA. So, what are a little bit more detail on the conventional side? So, credit score typically is a little higher. Like with FHA, you can go as like we discussed, as low as 500. Most lenders that I see as low as 580. Right. Some of the more conservative lenders will require a 620 or 640. For conventional, typically it's 640 and above. The lower your credit score, the higher your mortgage insurance if you're putting less than 20% down. And also the lower your credit score, the higher your interest rate is going to be. So typically for people that I speak to that want to buy with a low down payment, their credit score is going to determine a lot of the times which option to take. If they're coming in with 3.5% down or a smaller down payment like 4%, 5%, depending on where their credit score comes in, we'll compare, a conventional loan at that price point versus an FHA loan. And a lot of times, if the credit score is lower, it benefits you more on the FHA side because the interest rate is lower than on the conventional side with the lower credit score. So, just a couple of things for people to keep in mind. Here's one thing on FHA loans. So, in general, it's like, hey, you put 20% down, you don't have mortgage insurance, right? With FHA, you do. Doesn't matter. If you need to buy with FHA for whatever reason, right? Like maybe you had a bankruptcy where the conventional limits kind of limit you or something like that. And even if you have a large down payment, you're still going to have mortgage insurance attached to it. So just something to keep in mind. It does give you the ability to buy something with less underwriting guidelines or looser underwriting guidelines and maybe
That's a little less strict.
Yeah. But still have to have that mortgage insurance. With conventional, obviously, if you put 20% down or more, there's no mortgage insurance attached to it. So,
Yeah, I mean, it's going an FHA route is awesome. I think you just have to be a little more strategic and have a different game plan when you're going through it. And I know when I was speaking to you, I said I had all cash buyers, and we were just continually getting beat out by conventional loans. I think it kind of changed my mind as to why I like conventional loans, just because it does give you a little more flexibility to maybe remove an appraisal contingency in something like a seller's market. There's just certain things that I think it allows a little more flexibility, and it sometimes in some markets it is going to be viewed as, hey, these buyers are maybe a little more financially qualified. And that's just coming from me being on the selling side also and having these offers come through. That is how conventional is viewed.
yeah, because it's going to be difficult if someone's coming in with a large down payment, 20% down, and there's multiple offers on the table, and you're coming in with FHA at a lower down payment. It can present a challenge for buyers agents when trying to get their client's offer accepted. Specifically for those reasons that you said, is they might think they're not as qualified or whatever the case might be. So you might have to compensate a little bit on price to come in competitively and things like that.
Or just saying, hey, I'm willing to buy something that maybe needs a little bit of work. And in the long run, if you value your home, you're going to be making it yours. You're going to be adding value to it at the end of the day. And it's going to be a great property for you or your family or for your investment. It's just being a little more flexible as to your criteria. And that's what I try to convey to some of my clients too. It's like, hey, this new home that is hitting the market today, with all the bells and whistles, that island and that painted door is going to attract every buyer on the market. But if we go a week or two back and let's see some homes that are still on the market, maybe for, needs a little bit of work on the ground or it still has carpet, whatever it is, you could go that route and find a great property.
Yeah. Speaking of that, there is an FHA product that not a lot of people know about. It's called FHA 203K, which is an FHA loan that gives you, or you can get money lent to you through the loan for remodeling. And if I believe it, it's tiered. Anything under 35,000, it's a little bit easier. Like if the property needs, don't quote me on the exact amount, but I believe it's 35,000. If the property needs 35,000 or less in repairs, it's a lot easier to get approved. Obviously, if you go higher, you can go higher. Like let's just say $100,000. It'll be a little more involved. They'll want to see contractor bids and that kind of stuff to get the process approved. But it's still doable.
Yeah.
Where if you find a property that's a major fixer and you're able to do an FHA 203K, you don't have to use that out of pocket money to fix the property. You can kind of roll it into the loan itself, and then it'll be. Your loan will be what you purchased it for plus your repair budget balance, and that'll be your mortgage moving forward. But that enables people that are buying a fixer to be able to use the loan funds to fix the property up. So that's a great product. If you're able to find a property without too much competition, where they're willing to be a little bit more lenient with the loan process with you, because it does take a little bit longer. But if it's a fixer, it's perfect,
Yeah, and they're definitely out there. They're definitely out there.
Absolutely. So just touching base on, I wanted to kind of talk about briefly Proposition 19, which is something that has a few different components to it. One thing that I like a lot about it is that it allows for people that are 55 or older to
transfer that tax base.
Yeah, transfer their tax base. Yeah. So there's a couple other components to it too. If you're homeowners who are 55 years of age, disabled, or victims of a wildfire or natural disaster, it allows them to transfer their lower assessed property value of their primary home to a newly purchased or newly constructed replacement principal residence, up to 3 times or once per disaster. So the tax base can be transferred to a property located anywhere within that state. So this is speaking specifically for California. You can buy a property, and if you're over 55, you don't have to pay a higher property tax rate. You can kind of keep the one that you were in, because a lot of people, if they were living from their property for 30 years, that tax base is going to be a lot lower than if they're purchasing a new property. So.
I mean, as a new agent, I know agent to agent people know this, but people who aren't in the industry, when you start out in real estate, you don't really have a marketing budget. I mean, unless you come from, you plan ahead and you have a bunch of money, but a lot of times new agents need to do free things, right? They have to go door knock, they have to cold call. Well, I'll tell you, when I was door knocking the neighborhood that I was interested in, I don't know how many times I heard, I want to move, but why would I if my tax is so great and I already paid off the home? Like, I don't want to pay anything. Well, Mr. or Mrs. Homebuyer, most likely you're going to downsize, right? And you'll have an opportunity to transfer that tax base over. And Gerardo, I wish I would have known that when I was door knocking heavily, because they caught me in like a dumb moment where I would be like, oh yeah, maybe you're right, and then I'm on to the next house.
That's the beauty of experience. The more you're in it, the more you know. And yeah, and also it speaks to people, needing help with being informed on what they can do, because a lot of times they're thinking they have this limit, and it's stopping them from making a move that they might want. There's there's a lot of people that are older that have maybe larger homes where it takes too much for them to maintain that property, and would be interested in downsizing or getting something smaller where it doesn't take as much work to keep the property, you know.
Yeah, and I mean, imagine in this market with the upside that sellers are finding, you know, especially if they're downsizing, they could find something for a very good price and not feel like they're burdened on that tax end. And I mean, these kind of things are really powerful. And you know, it does take a good realtor or someone who likes that research to be able to present these opportunities to those buyers or sellers.
Yeah, because people that want to sell their home, take advantage of the market, but are holding themselves back for reasons like the tax base and things like that. This might help, put some more properties on the market for people that already want to make a move anyways, right?
Yeah.
I know some people, they like to move to, when they get older, they want to move to like a 55 and older community or something along those lines to kind of live in their retirement years in these communities that have people that are going, through, that are similar age as them, have similar interests and things like that, but are scared to sell their home for those reasons. So hopefully this can help some people and shed some light on being able to save on your property taxes if you do transfer and purchase another property. So something to keep in mind. So yeah, man. Well, it's been super good to talk to you today. I'm glad you got one of your clients in escrow. Hopefully it goes smooth.
It was those cash clients, so it's 2-week close.
Yeah.
Nice.
People, even though rates are up, people are still searching. There's still a shortage of inventory. I know I have some buyers that are, the rate went up, but they're still interested in purchasing. And we just had a listing that went into escrow as well, and we had a lot of offers, and it went above asking per, same as it has been for the last couple of years. So it's still competitive out there, and I feel like the ones that are committed to purchasing are seeing a little more opportunity, because obviously there are some people falling out with the interest rate hike or being
or frustrated, man. I mean, and this is not to brag, right? So this will be my biggest deal, but it's such a crazy market that we were looking at the $1.4 million mark. And when it was all said and done, there were 43 offers on the property, and 12 of those got countered. And at minimum, they were $250,000 over asking.
Wow. Where's this property located?
So we battled a little bit. So we've been in Orange, similar story, and we've been in San Juan Capistrano, and we've been in Costa Mesa. And, like I said, we're all cash. We usually get countered, but at the end of the day, for the last, 6 months, people have been, looking at dream homes and doing whatever it takes to get in.
Yeah. Well, kudos to you and your client for sticking with it. And hopefully escrow goes well.
Yeah, man.
So if anybody wants to get a hold of you, what's your preferred method of?
So Lorenzo El Realtor. You can find me on Instagram, Twitter, or you can look it up online, LorenzoElRealtor.com, and you can find me. Reach out, please.
Yeah, Lorenzo Keller Williams. This is Gerardo. You can reach. If you want to find me on Instagram, SoCal Broker. It's easy to DM me there if you have any questions about any loans or anything real estate related. Feel free to reach out. In the meantime, until next week, Lorenzo, we'll be in touch. Much love, brother. We'll talk soon.
All right, man. Have a good one.